My name is Sean van den Berg. I head up client education at PSG Online. Welcome to our session on trading equities derivatives. This is our evening session, so we'll see how it goes with the evening session. But here's my agenda for today. We're going to talk about the terminology. A lot of people get hooked up on the terminology. So it's important to understand that. So we're going to explain single stock futures. What are single stock futures? And obviously focusing mainly on the equity single stock futures. And then we're going to talk about index futures and then contracts for difference. And explain the differences between the two of them, between single stock futures and CFDs. And I'm going to go through some examples of long and short trades. So that's the agenda for tonight. It should take about 45 minutes. Any questions you guys have, please just type it up in the little question box, and as we're going along, I'll try and answer those questions. If I can't answer the questions as we go along, I'll answer them, obviously, the questions at the end. If I don't answer it at the end, you'll be getting the questions answered by email. Secondly, this presentation is being recorded, so you will be getting an email tomorrow with the links to the actual PowerPoint presentation as well as the recording. So the idea is that you'll be able to review it, and again, any questions you might have, you're please welcome to send it through to me. Okay, so let's get started. I hope you guys can hear me loud and clear. I hope you can hear me. If you're not, someone just confirm that you can hear me. Just type in the question box, yes, you can hear me. I appreciate that. I try to do a sound check before we got started. But anyway, let's talk about the terminology involved, just some basics. So first thing we talk about when we talk about derivatives, I refer to it as equity derivative. So it derives its value from an underlying share. Remember, another name for a share is an equity. So you still have to do the homework on the Sassels and the Anglers and that kind of stuff. So it derives its value on the underlying share. That's where the word derivative comes from. At PSG Online, we only trade the top 100 companies. That's the top 40 companies, the large caps. That's by size. And the next 60 companies, what we call the mid caps. So we make the list a bit easier for you. It's only the top 100 by size. You get, with the advantage of derivatives, you can go long and short. In other words, you can take advantage of rising prices and falling prices. Especially right now where the market is quite toppish. You might anticipate a correction soon and the market to come off. You're going to take advantage of that, and that's where you'll go short. You'll see just now we talk about a list of CFDs and single stock futures. There are some single stock futures and CFDs that you can only go long. In other words, that there's no scrip available. You can't go short those stocks, example. We say long only. What happens? PSG goes into the market and actually buys the actual shares and hold it as collateral. So some of these shares are very tightly held, and there's not enough to go around. And that's why we have long only. We talk about initial margin. Now, this is the big difference between single stock futures and shares, where with shares you have to put down 100% deposit. Derivatives, they are geared products. They use leverage. So you're putting down roughly about 15% deposit to have the 100% exposure. So in other words, you're putting down 15% and you're borrowing the other funds to have the 100% exposure. Okay. So being a geared product, you must understand for each share, the share moves in your favor, you multiply that by up to 10 times. So if I'm putting down 15%, your gearing is at least 6 times. So gearing does magnify your profits or your returns as such. That's the easy part to understand, the deposits. Like buying a house, you put it down a deposit to have ownership of the house. But originally, when you first buy the house, 50% is deposit and 90% is what the bank loans you. Who owns the property? The banks. Okay. So in this situation here, you have exposure to the 100% of the shares, but the PSG actually holds the shares as collateral. The difficult part most people don't understand is that 15%, that deposit gets ring-fenced. You have to keep it at 15% all the time. And any unrealized profits and losses on the daily basis has to be what we call topped up. Okay, it goes through the process of what we call mark to market. Okay, it's processed daily onto your account. It's what we call variation margin. So if you bought something at 10 Rand and it's gone out in your favor, it goes to 11 Rand, that 1 Rand will be in your account tonight, that profit. What happens if it goes against you? You anticipated the market to go up, and at 5 o'clock the market actually closed down at 9 Rand. That 1 Rand difference, you need to top up the next day. It's what we call a margin call. So if you don't have enough funds in your account, you need to top up, you need to transfer funds before 3 o'clock the next day. Okay, so as we talk about the top up. Alternatively, you close out the contract, and the difference is we take it out of your initial margin, which is the deposit. Okay. Let's talk about opening a position. Okay, this is where you go long or go short. So if you're opening a long position, you're anticipating rising prices and you'll be buying, like we do with shares. Okay, you'll be anticipating rising prices, you'll be buying the share. If you anticipate the price to fall, you'll be selling. So with a long position, you buy something at 10 Rand to sell it at 15. Okay, with a short position, you sell at 15 to buy back at 10 because you're anticipating the difference. So both ways you're making 5 Rand, but you're just trading the direction of the market. So it is quite difficult to get your head around the short positions, short trading, but we'll show you some examples just now. You'll get a better idea of it. So we talk about closing a position. So if I'm long, you just do the opposite. You sell if you have a long position, and you buy if you have a short position. So it's just doing the opposite. That's what we refer to as closing a position. Now when it comes to single stock futures, we also have a rolling a position. So remember, these are futures. They have a life. So 90 days every quarter, they roll over to the next contract. We're at the moment trading the December contract. We roll over to the March contract. Okay, so it's an automatic closing and reopening of the same instrument, but into the next expiry contract. Okay, so that's a default situation when it comes to single stock futures. It automatically will get rolled over on the equity side. Okay, we'll talk about the Aussies just now. So let me see if there's any questions coming through. Can hear you well. Okay, thanks, Louise. Okay, appreciate that. Let me see if there's any other questions. Great. Okay. Let's move forward. Let's talk about single stock futures. So we're going to go through the basics. What is a single stock future? Then compare them to equities and things like that. And then look at the costs. And then show you how to use these things. Okay. So first thing about single stock future, compared to a CFD, single stock futures are regulated by the JSE. So it's a standardized contract of a standard quantity of 100 shares. So the minimum you can buy is one contract. Remember, one contract equal to 100 shares. So we spoke just now about a derivative. So single stock futures and CFDs are derivatives. So derive its value on an underlying share. We only trade the top 100 companies. And as I mentioned just now, being a future, they do have expiry dates. So the third Thursday of every quarter in March, June, September, and December, single stock futures will close out or roll over to the next position. Okay, so those are the two options you have. Either you're going to close out your position or you're going to roll over your position. So at the moment we are trading the December contract until third Thursday in December, and then we roll over to the March contract. As I mentioned just now, these are geared products, so you're putting down roughly about 15%. Now this initial margin is decided by the JSE on a quarterly basis. That's a random amount. So as a percentage, it's roughly about 15%, but it varies. Okay, so if I'm putting down 50% deposit to have 100% exposure, my gearing, my leverage, it can be up to 6 times. Okay, and remember, as I say, what's important is you need to ring fence that gearing gets. Initial margin gets ring fenced. So you have to have some spare cash available in case there's adverse price movement against you. That's what we call variation margin. Okay. So I always joke, with single stock futures and CFDs, these things do come with a wealth warning. You can lose that more than your deposit. So you can lose the wealth, the deposit plus a house plus a car. Okay. Not necessarily in that order. So you must understand that these things are risky. Very, very important that you manage risk, and we'll talk about it just now. Let's compare single stock futures trading to equities trading. So on the left-hand side here, we've got investor age, a share trader. She's confident the Sasol share price will increase. Okay, the oil price is going up, the rand's getting weaker, they'll take advantage of it. She's got 48,000 rand to invest. And let's say, for example, Sasol share price right now is trading at 480 rand. So she goes and buys 100 shares. So we're excluding brokerage and things like that, just to keep it simple. She goes buy 100 shares. 3 months later, Cecil's share price has gone up like she anticipated. The price has gone up 10%, and she makes 4,800 Rand profit. That's not too shabby. If you look at it with equities, if you had to analyze that, you're doing pretty well. So return on investment is 10%. Now look at exactly the same scenario now, but from a single stock futures point of view. Also optimistic about Cecil's share price going up. Okay, the shares trading, underlying shares trading at 480 Rand. So she goes and buys one contract. Remember, one contract is equal to 100 shares. Exactly the same scenario, but the only big difference is now I put down an initial deposit or initial margin. In this situation, the initial margin in Rand terms is 5,478 Rand to have exposure of 48,000. Okay, now that gives us a gearing of roughly about 8.76 times. Okay, so that's the gearing that's involved here. So same exposure, but I'm using less funds. So it's very capital efficient. That's what derivatives are. They're very capital efficient. I can use all the extra cash now for other positions. So 3 months later, the share price has gone up 10%. I do the opposite now. I close out my position. My profit is 4,800 Rand. But my return is obviously much higher because I'm looking at 4,800 Rand as a percentage of my initial margin. So in this situation, 87.62%. That's what gets people, traders excited. So it's capital efficient, and obviously you've got this gearing now. Okay. So let's talk about costs. So capital efficient, you've got this gearing. Also, they're very, very affordable, cheap. Compared to equities, these are half price. At PSG Online, we have a sliding scale, 0.9% for the first 25,000. With the single stock futures, we have a flat rate of 0.4%. Okay, that's excluding VAT of the value of the total transaction. Okay. You also have 0.1%, what we call market maker's commission, because we're trading through a market maker, RMB, that makes a market for us. So your total brokerage is 0.5%, that's including that now. There's also a booking fee. When it comes to single stock futures, there's a 60 Rand booking fee charged per contract when the new position is opened. So you only pay this on the opening leg of all transactions. You only do it once per single stock future. So for example, if I buy Cecil 10 times a day, I only pay that 60 Rand once. But just be careful. If I buy a contract today and I buy another contract tomorrow, that's another 60 Rand. And that is a percentage of your cost, will push it up a bit. So just be careful with that kind of stuff. Remember I mentioned just now you're putting down roughly about 15%. You're borrowing the other 85%. So obviously there's interest involved there. So there's interest payable. Interest is paid on the transaction value, and that's determined by the market maker. That's what I said by RMB, and that's roughly at the ruling SAFEX rates. So it's very competitive, and obviously they're looking for the business. But you also find that interest charged on single stock futures are slightly more competitive than compared to CFDs. We'll discuss it just now. You also get interest paid on any of your cash balances as well as your margin. So just to give you some background there. At PSG, we trade what we call dividend neutral contracts. In other words, you don't actually receive the dividend. So how does it work? We talk about end contract. So if you look on the left-hand side here, let me just get my spotlight. So we talk about an end contract. So the total value is 100 Rand. Okay. Then we're broken down to a Q contract and the F contract. So the Q contract will be the underlying share price. Okay. If I am long, I receive the dividend. So the 5 Rand plus the 95 Rand makes up the end contract. If I'm short, I pay out the dividend. Okay. So the idea with dividend neutral contracts, it's automatically priced into single stock futures, and obviously any interest will also be accrued to that dividend payment. So the main important thing you must understand that you actually do not receive the dividend. To reflect on your portfolio, but you don't actually receive it. As I say, it's dividend neutral. Okay. So here's an example of a trading account. This is a Mediclinic. You can see that's the Q contract. There's the F contract. So there's 5 contracts. There's 500 shares in this situation short. So remember, if I'm short, I'm paying out the dividend. So the difference between here and this, here we're talking about 28 cents. So 500 shares times the 28 cents, that comes to that 140. Okay. So I'm paying out the dividend because I'm short. So if I had to take the two of them together, net them off, I'm slightly up R1.25. Okay. So as I say, it is reflected on your holdings account, but obviously you don't actually receive the dividend. Okay. One of the major advantages I feel about single stock futures, if you're an equity shareholder and you're a long-term investor, these are great to hedge risk. So you have example, you might have some Naspers shares in a long-term portfolio, and we're very close to that 1,000 Rand mark now. But what happens, you anticipate that this market's going to fall very soon. It's overvalued. It has to crack soon. Yes, it's trading above its moving averages and trading above its channel, but what if the market goes against you? What happens if it pulls back to at least a 50-day or 50% Fibonacci retracement, which is roughly about 200 Rand off? Okay, so this is where the advantage comes in. So I've got a situation where, I have a 500 Naspers shares in my portfolio. I anticipate the share price to drop by 200 Rand. So I've got a potential of losing 100,000 Rand in my long-term portfolio. I don't want to sell my shares because obviously I might be taking capital gains. But also I'm a long-term buy and hold investor. So I don't want to trade. Okay, so I want to hedge my position. And this is where advantage is. So whatever my exposure is, I have exactly the same scenario with the single stock futures. Like I buy 5 contracts, which is equivalent of 500 shares. If the share price drops by 200 Rand, if I'm short, okay, I make up the 100,000 Rand on the single stock futures. So that's a balance. It balances out. Okay, that's what we call about a hedge. Okay. So yes, bottom line, you might pay tax on that gain. It's profit, but at the end of the day, as a long-term investor, you're protecting your position. Okay. So there's pros and cons. You've got to look at that way. That's one of the tools where our people would use single stock futures as a hedge against a long-term portfolio. So quickly, just to summarize, the advantages: they're capital efficient, they're cheap, you can hedge your portfolio. And remember the trading platform itself, okay, it's direct market access. You can place trades after hours, and as soon as the market opens in the morning, it's going to the market for you and things like that. Also a facility where you can place stops and things like that. So we'll show you some examples just now. The disadvantage, obviously, there's interest payable. There's that quarterly rolling fee. By the way, I forgot to mention that. That rolling fee is 0.25% of your exposure. So if you're looking at rolling positions all the time for the next year, you've got additional 1% cost when it comes to single stock futures. To say they are dividend neutral, you don't actually receive the dividend. And obviously, I can have 1,000 contracts on SSF. I don't have voting rights. Remember, it's derived as a derivative. It derives its value on underlying share. You're not an actual shareholder. And then lastly, obviously, it can be a disadvantage, the gearing and the risk, if you don't know how to handle it. So it's very important that you know how to use stop loss and position sizing and that kind of stuff to minimize or to manage that risk. But I still believe that the advantages far outweigh the disadvantages. Okay. So let's talk about how these things work. On our website, by the way, to have a single stock futures account, you need to go register or open a single stock futures account. So you might have an equity account already with us. You still need to open up a single stock futures account because there's different risks, there's different mandates you have to sign. Obviously, if you don't, we've got your fee, I don't have to redo it again unless you did it quite a long time ago. You might have to just send us updated utilities bill. Anyway, you log in with your username and password, and you click on the button here called Indices, and in the Futures, a little tab, and then there's a little tab here called Futures Available. This is what gives you all the single stock futures available for you to trade. It's all alphabetical, and it goes by code. So again, I always believe that if you don't know what the code is, you haven't done enough homework. So the first one here, we're looking at ACL, which is Ocmetel, which is a steel company. You can see in the background here, it says steel there. These are orders, December contracts we're trading at the moment. There's an initial margin requirement to open up a position now on Ocmetel. Okay, 711 Rand, that's all you need. You see, you can go long and short. That's both. Come down here to Amplats. You can see it's an L there. L refers to you can only go long. And same here with Coronation. You can't go short on those stocks because there's not enough script available. Okay, so it's a good idea to maybe print this list out to orientate you to see what's available, but also to have this list available of initial margin. These things, remember, they change on a quarterly basis with the futures closeout. Okay. This is what the platform looks like. This is if you click on your portfolio, once you start trading, this is what your holdings account would look like. In this situation, that we're all short. You can see we're short of Anglers, Mediclinics, there's a Dividend there, MMI, Redefine, and things like that. There's all the different contracts. There's the margin required. As I say, the nice thing about it is you don't need a lot of capital to get going. Okay, you have to put roughly about 30,000 Rand down. Okay, as initial margin to have exposure of 312,000. There's also what makes single stock futures and derivative and CFDs attractive is that gearing. Okay, that margin requirement is it's not so onerous. Okay, so that's what the holdings of portfolio look like. Let's say, for example, you're going to go trade a single stock. You're going to trade a short on Old Mutual. Okay, so I got the code wrong here. This is OML, not AMN. Okay, so anyway, you do your technical analysis. You anticipate the breakout of this triangle back down to this maybe the 200-day moving average. You go short at 30 Rand, 35 Rand, 30 Rand, 35 cents with the idea of buying it back at 28 Rand. So again, you go back to the platform, you click on new order, you enter the share code OML, click on go. Okay, it'll give you the bids and offers like you see with normal equities. There's your margin required. Okay, 390 Rand to have exposure to one contract, 100 shares. So I decided to go with 2 contracts. Okay, there's my price. You put it in cents. In this situation, 2 times 100 shares. Okay, that's my exposure. Okay, 6,070. There's my margin requirement, 390 Rand times 2. So my margin is 780 Rand for the two contracts. My gearing as such is 7.78. You don't have to work out the gearing. I just do it for myself just to see what it's like. Okay, so once I selected the share code, I click on go. What I want to do now is I want to do trade. Remember, I want to go short, so I select either long open or long short. Short open. Remember, I want to take advantage of falling prices, so I go short open. How many contracts? My price, and I click on submit. I suggest that you first get the contract and then come back, click on new order again, and then come back and put your stop loss in place. Okay. Now, I always believe in putting a stop loss I get my stop loss from my charts, the support and resistance levels. Remember, if I'm short, I don't want the price to go up, so I want to look at resistance levels just above that. So in this situation, I want to close out my position. Okay. If it goes above 31 Rand, okay, I want to close out my position because it's going against me. So 31 in cents. Okay, I want to close out my position, my 2 contracts. Just be careful. I suggest you always put 2 contracts. Don't just put in 1 contract. You want to close out your whole position. But also be careful. Don't put out 3 contracts. Remember, I'm short 2. If I put in 3, I'm going to close those 2 and go long 1. So those kind of things you must be careful of. And the worst case scenario, I always suggest that you may have slightly bit higher than your trigger, because we talk about a price watch and a stop order. They have to work together. If you only put a price watch, you're going to get a SMS and an email. They have to work together. I always call the price watch the trigger, and your stop order is a bullet. So just slightly a bit higher in this situation because I'm short. I'm going to close up my position. So if it triggers, it'll be triggering at 31 Rand. Worst case scenario, 31.50. Okay, I click on submit, and I sit there in my order book. As I say, it's very important that the price watch and the stop order have to be used together. Otherwise, you just get an SMS and an email. Once the order is triggered, then it will only show in your order book. However, it will be reflected in your price watch. If you go click on your price alerts, you'll see that the order is waiting there for you. Okay. So very, very important to use it to minimize your losses. Let's talk about trading Aussie futures and ALMI futures. This is, I believe, is more for the call it the day trader. They're great little tools, but also obviously different kind of trader needs more margin. So Aussie futures are based on the top 40 index, so it's the basket of the top 40 stocks. Okay. Remember, most of the stocks are rand hedged, so you need to take in consideration the rand. If the rand is strong, most of those stocks will be falling. If the rand is weaker, that index should be going up. Again, you can go long and short. We spoke about it already. The Aussie future is very, very liquid, because obviously a lot of the institutions, the pension funds, unit trust guys, use Aussie futures in that to hedge their positions. They're very, very cheap. Only cost you 25 rand. That's including VAT to open up a contract. There's no booking fee. There's no 60 rand booking fee. So these things are very, very cheap. Okay, and the spreads, the difference between the bids and offers are very, very narrow. You'll see an example in the next screen. Okay, but each point, remember we're talking about an index now. Each index point is worth 10 rand. So the guys will go, for example, for a 100-point move, that's equivalent to 1,000 rand profit or loss. Okay, that's a minimum per trade that I want to go for. You know, I like to go for maybe 105. That'll cover my costs in and out the market. Remember that 25 rands to open and another 25 rand to close. The big difference now is the initial margin is much higher. It's roughly, at this point in time, 34,920 rand. Okay, so we trade 1.5 times SAFEX rate, what the SAFEX requires. So we do ask for a higher margin, but it's also there to protect you. Okay, any profit and losses on a daily basis will be processed through the market to market, and obviously, as the index, the market is moving in your favor, that funds will be in your account tonight. If the market moves against you, you need to top up. One thing about Aussie futures or the trading index futures, they do not expire. I mean, they expire, they do not roll over, so there's a closeout. So you have to physically go open up a new contract. So yeah, in December, they'll automatically close out, and then you'll have to open up the March contract. Okay. ALMI future, this is just a mini version of the ALSI, where the ALSI gives you 10 times the market. This is 10% of the ALSI. So they are not as liquid, but it is improving, as well as the spreads. The difference between the bids and offers are spreading, are narrowing. With the ALMI, to create that liquidity, there's a market maker that helps track the market and tries and create that liquidity. So if it's 10% of the market, each point is only worth 1 rand. So this is a great little stepping stone for those of you who want to start trading, day trading. Again, you get your margin requirements. So in this situation, it's 10% of the ALSI, which is 3,492 rand. To say it's very cheap. It's 5 rand, and that's including a brokerage, including that. No booking fee. And remember, these things do not roll over. They will get closed out. Okay. So here's a little screenshot of the ALSI. As I say, they're quite high now. We're making new records. I'll be watching this trend line very, very closely. If it triggers come back a bit, I'll be looking at going short. Although we're still trading way above our 50-day and 20-day moving average, the trend is bullish. I personally don't like to short very strong shares. You can see we've still got upside potential on the stochastic and the RSI. Only when we get really oversold and this goes back, like we have a scenario here where we break out there, that's where I'll go short. But again, different strokes for different folks. This is what it looks like intraday. This is the example. This is only 3 hours intraday. A candlestick chart. There's a 200-point drop on the ALSI, and that 200 points times 10 rand, that's 2,000 rand you make in 2,000 in 2 hours. Okay. So what the day traders would use. And obviously, it depends on the contract you got. Multiply that by the number of contracts that you profit and things like that. As I say, very, very cheap. So what it looks like, again, you'll go click on new order. You'll find it's under the central order book. Okay, so you click on the central order book, and it takes you through to a page like this. You click on the drop-down list, and you can select the contract you want to trade. Then we're trading, in this point, this webinar, we're focusing on the ALSI and the ALMI. So here we select the ALSI December contract, and then that's what it looks like. This is a snapshot in time. It has 3 contracts. This is the index, remember? So 39,718 points compared to 3,727. So roughly, what's that, 9 points difference? That's 90 rand. So obviously that you take in consideration. If I'm long, I'm buying from the offers, and I'm short, I'm going from the bids. Okay. So in this situation, I want to go short. So I go sell. How many contracts? Yeah, you type in rand. Remember, it's in rand now. Okay. 392, okay? You put that in points. I click on submit, goes into the order, into the market, like normal. Here's the ALMI, exactly the same scenario. You see the spread is 5-point spread there. Say one contract, remember my margin is 3,000, in this situation was 3,037, okay, 3,307 range, sorry, that's an old slide. Okay, so there we go, that's what it looks like. I'm short one ALMI contract, 307.50, that was my cost, okay, and things like that. You say I'm up 14 Rand, okay, the market has gone up 14 points since I bought them, okay. So a quick summary, single stock futures, okay, you can go long and short. And a lot of people always think you can only make money when the market goes up. You can make money when the market goes also, or when the market falls. As I say, with the market falling, you can also hedge yourself. Also, most people use it for speculating. So the gearing is very attractive to a small trader. Single stock futures are great for the swing trader, someone who holds a position from 2 days up to 30 days. Remember, we only trade on the top 100 companies, minimum outlay, and obviously minimum cost. The ALSI is great for the serious day trader, where the ALMI is a great stepping stone towards the ALSI trading. The main thing about single stock futures gives that peace of mind that they are all regulated. There is that counterparty risk, and through SAFCOM and things like that, the clearing members will take on the risk. Okay, so guys, we're running out of time. Let me just quickly go into contracts for difference. I personally prefer CFDs. They are less complex. That's my opinion. You'll see just now, especially when it comes to the pricing side. With single stock futures, you're buying the underlying, and then with the mark to market at night, it's converted over to a single stock futures the next day. Okay, so with CFDs, you're still trading the underlying. There's no conversion or anything like that. So a very similar thing to single stock futures. The same terminology applies. Big difference now. The word CFD means contracts for difference. It's a contract between two parties. You as a client and PSG online, the stockbroker. All it is we are going to settle the difference between where we bought it at and where we're closing at. The difference between the opening price and the closing price. That's all we're doing. That's a very simple way of looking at it. The big difference when it comes to CFDs compared to single stock futures is that PSG decides on the initial margin. So PSG at this point in time has decided 50% initial margin is required for top 40 stocks, and then 17.5% of the value for the next 60 companies. So you find that some situations might be better to go for single stock futures because of the gearing. Some of you want to have a higher risk, but I'm perfectly happy. I'm perfectly happy to trade CFDs on those criteria. So we still need a variation margin to top up if the market goes against us. So it's very similar. The big difference when it comes to CFD is that there is a minimum cost value. We have a minimum criteria that the value of the transaction must be at least 25,000 Rand. So if it's a top 40 stock on 15%, your minimum margin requirement is 3,750 Rand. If it was a mid-cap stock, that's from 41 to 100, your initial margin is 17.5%. So the minimum minimum margin required is 4,375 Rand. So it's not for everybody. Single stock futures are a bit more affordable. You saw just now it's Old Mutual, 310 Rand. But so there are pros and cons. I suggest open up a single stock futures account and a CFD account. I like to move the funds around between the two of them. If there's an opportunity to go short, I prefer to use single stock futures. If I'm more of long positions, I like to use CFDs. Very similar to single stock futures, your commission, your brokerage is 0.4%. That's excluding that, so 0.57. With that, 0.47%. But we are open to negotiate the brokerage rates for the large and active traders. So you just phone our brokerage trading desk, they'll help you. Remember, there's no booking fee and there's no market makers commission. So they are slightly cheaper on the brokerage side. However, when it comes to the interest side, obviously the interest rate is slightly higher than with single stock futures. Your RMB, these guys are market makers, they're competing with other market makers. They'll try and get you the best interest rates. PSG Online, obviously, we're making that market there for us. and it's roughly what we call prime less 2, so we're talking about what's that, 8%, 8.5%. So it's going to cost you about 6.5% per annum to borrow those funds. I still believe it's very, very cheap. Okay. Other thing it comes to CFDs, there's a scrip lending fee if you want to go short. So it's 1.5% per annum or minimum of 250 Rand per position. I personally prefer to use single stock futures. You save on that cost. Okay. So to say you're paying roughly about 6.5% to borrow that the other 85% on your position. Okay. Here's an example, practical example. I'm going to go buy 1,000 Old Mutual shares. Okay, at 30 Rand 42. That's my exposure. My initial margin is 50%, 15% because it's the top 40 stock. So I'm putting down 4,563 Rand in margin. Okay. So my gearing is 6.67 times. My brokerage, okay, 0.4% of that exposure, 121 Rand. If we had to look at the same scenario, if it was an equity trade, 0.9% for the first 25,000, okay, it's 225, and then the difference between the 25 and the 30,000 is 5,420 Rand, additional 45 Rand there, so combined 270 Rand. And our minimum brokerage on equities is 98 Rand. Yeah, we're talking about 121 compared to 270, so say it's half price. With the VAT, 138. Okay, there's the interest on costs. So it's remember it's a SATX rate, and this is a daily rate, by the way. So that plus the 2% is 6.73% times my exposure. It's going to cost me, if I hold it for the whole year, 2,047 Rand. So divided by 365, 5 Rand 61 per day. That's what I'm paying in interest. I'm also receiving interest on my margin. Okay, so 34 cents. So that gives you a rough idea how the interest would be calculated. Okay. So bottom line, let's go through it very quickly. You can see cost-wise compared to equities, 1.3%, and against the CFD, 0.46%. So they're very cheap, very affordable. Okay. We're going to compare single stock futures to CFD. The main idea is that with single stock futures, there's expiry date, and obviously 0.25% rollover cost. With CFDs, there's no expiry date. So this is ideal for what I call position trading. This is for someone who's got a longer term view. We talk about a swing trader between holding position from 2 days to 30 days. A position trader holding from a few weeks to a few months to a few years. Okay, but obviously you must take into consideration your interest rates and things like that. Remember, yeah, we're not getting any dividend. Okay, with CFDs you actually get a dividend. However, it is what they call a synthetic or a manufactured dividend. Okay, so you do actually get the dividend. So those are the pros and cons that look at very, very quickly. So again, if you have a login, you can click on indices, click on on futures. There's a tab here called CFDs. That gives you that same list you saw just now with the single stocks, but now you see the margin requirement. Okay. What I do is this: I copy this and put it into Excel spreadsheet, and then I rank it based on the margin requirements, and I split it 15% and 17.5%. So I know these are the top 40 stocks, and these are the mid-cap stocks. Okay, so that's one way of starting to look at creating a watch list. Okay, so your CFD platform looks exactly the same like your equities and like your single stock futures. In this situation, we're all long. There's the share code. There's in shares, in quantity, cost, and things like that. Again, I'm putting roughly down with my margin, creation margin. There's my initial margin, putting down 37,000 Rand margin. You have 231,000 Rand exposure. Okay, so it works exactly the same way. Remember, if dividends are due, you'll get paid dividends that come into your cash account. Okay, so here again, on the go long or short of Old Mutual. So exactly the same thing, new order. Again, remember, you have to open up a CFD account. There it says CFDs. Okay, so you enter your share code. There we go. On to go short, and now you put in how many shares you want to buy, quantity. As long as it's more than 25,000 Rand, the exposure, the trader go through. So that times that, you can see there's your margin required. As soon as you bought the share, come back and then put in your stop loss. Okay. So that's how easy it would be. So let me just go back quickly. So quantity, I want to buy 1,000 shares. That's my price in cents. And I click on submit. Goes into the market like a normal share. I'll buy 1,000 shares. So I'm in this situation, 3042. I'll be joining the queue here. Okay. Oh, sorry, I'm short. So I'll be the best seller. Remember, it goes from the highest seller, from the lowest seller to the highest seller. So I'll be the best seller. Remember, I'm short. So I'll be joining the top of the queue. So remember, we need to join. We need to agree on price. So there'll be a 2 cents difference. So I've got a very good chance of obviously fulfilling my order. Okay. So remember, we're talking about CFDs here. I suggest rather use single stock futures to go short. So as soon as I bought the share, I come back, click on new order, come back again, and now you put in your stop loss. So remember, I was short of 30 Rand. Let me go back again. 3042. So in this situation, I'm short. I don't want the market to go up. It goes against me. So if the market goes above 31 Rand, okay, I want to close out my position. So I want to be alerted. So that's why I select price watch. And then I want to close out my position. I want to close out my 1,000 shares. And worst case scenario, 31 Rand 50. Okay. I click on submit. It goes into my price watch. The wait there. Again, same scenario. You need to use the price watch and the stop order together to execute the trade. If not, you'll get just an SMS and email. Very important that you use the price watch and stop order together. They work as a bullet, as a trigger and a bullet. Okay. Only when the order gets triggered will it be reflected on your order book. Okay. So I hope that makes sense to you guys. So quickly, just talk about the pros and cons of trading CFDs. They are capital efficient. However, there is a minimum quantity. Remember the exposure, 25,000. They're low trading costs. There's no expiry date. So you save yourself 1% when it comes to rollover positions. So say the rollover cost. So this is ideal for the position trader, someone who's more of an active investor, call it that, but someone who's got a longer term horizon. I say you can hedge your portfolio. I've got the question mark there. Just understand that there are script lending fees involved. Okay. Same with CFDs and same with single stock futures. My goal is to take advantage of capital growth. But remember, with CFDs, you've got advantage of getting dividend income. Okay. So again, a trading platform. I've got direct market access. I can place orders after hours, and also got a stop loss facility. Use that stop loss facility. Remember, these things are derivatives. There's gearing. If you're not handling the gearing or the risk, you can lose more than you deposit. So if you look at some disadvantages, they say it is a disadvantage. You got to look at the exposure, script lending fees, gearing and risk again, and then no voting rights. You can have 1,000 old mutual shares. You cannot attend the AGM as a shareholder. You're a trader, not a shareholder. Okay. So here's some examples of long and short trades. This is a trade we put on at the end of August. This is a property company called AccuCap. By the way, this is a report we write on a daily basis called the Stockbroker. Those of you who have a fully funded single stock futures account or CFD account, you're welcome to subscribe to it. It doesn't cost anything. It's a tool to help you maybe put out trades for you, highlight opportunities. Anyway, this was a trade we put out. This is a long at 41 Rand 60. My take profit was 46 Rand 24. So we do all these things for you. We calculate our stop loss. That was the low year. So I work out the risk reward ratio. I'm willing to risk 1 Rand to make 2 Rand 34. You should never go for a trade less than 1 to 2. Okay. So in this situation, I had a potential profit of 4 Rand 64 per trade, and that's the difference between when I bought it and when I sold it. That is percentage of my entry price at a potential of making 11%. That is percentage of my 17.5% margin. Okay, on CFDs would give me a 63% return. Okay, better look at that way. It helps you work out the profitability as such. That helps you with risk management. The other side of the coin, I want to look at position sizing, which is money management. So if you've got 100,000 Rand starting capital, you should never risk more than 2% per trade. So I'm risking 2,000 Rand. That, remember my stop loss was 9 Rand 20. That's the difference between the 2 year. Oh, no, not 9 Rand 20. So, sorry, this is wrong. It's 1 Rand 60. Oh, sorry, the wrong slides here. Okay, it should be 1 Rand 60, and then you can work out the difference from there. Oh dear, I took the wrong slides here. I'll have to update this before you guys get the presentation tomorrow. Okay, but you'll see some other examples. Anyway, this trade was this breakout. We eventually revised our profit down. We see on the single stock, on the stochastic and RSI, we thought, okay, it's gone too far. We hit a ceiling here. We revised our take profit down. Originally was 46.24. We revised it down to 44. So ultimately made 7% on our trade. Remember that 7% as a percentage of my 17.5%. You're not doing too shabby. Okay, we're doing okay. Here's another example of a trade we put on. This is on MTN. This was the end of September. 11th of September. By the way, as I said, that's what the actual stockbroker looks like. We write the whole spiel there. We anticipated a little breakout of this down channel, which did happen. We oversold, and that's why we put this trade on. But our risk-reward ratio is 1 to 2. That's the kind of thing we're looking for. And here's the example I was talking about, the stop loss and things like that. Ultimately, the trade went up, and we got nervous at that point in time there. It was oversold, overbought, and we got out over there. We revised our take profit down from 205 to 193. We made 4% on that trade eventually. Okay. So it doesn't sound a lot. Remember, these are geared products. So multiply that by roughly about 6, and you see what we're talking about. Those are examples of some long trades. Here's an example of a short trade. This was on MMI. We're selling, so we sold it at 24 Rand with the idea of buying it back at 22.85. Our stop loss was above that, okay, above that level over there, 25.50. But again, my risk reward scenario was 1 to 2.37. So as long as it's 1 to 2, I'm willing to risk 1 Rand to make 2 Rand. That's the kind of thing you're looking at. So this scenario, again, 7.83% potential return. There's my stop loss and things like that. My position sizing, by the way, the idea that is I divide my stop loss into my 2,000 Rand, which is my 2%. And that gives me my how many shares I can go buy, how many contracts. In this situation, 2,817 shares as such. Being a single stock futures, I could have bought 28 contracts. If the market goes against me, worst case scenario, I'm losing roughly about 2,000 Rand. Okay. So it's a good way to manage risk. On one side, stop loss. The other side is money management. Combine the two together. The idea is that you want to stay in the game longer. You don't want to put all your money on black or all your money on red, like we have a roulette table. That's high risk, aggressive trading, and that's what I call gambling. Okay. So ultimately what happened with MMI, remember we were short. That's where we went short. The market did break down. We eventually went sideways. That we should have closed out. We were a bit greedy. We wanted wanted more. But ultimately, we revised our stop, and we were closed out today. Okay, we closed our stop out at 25 Rand. So we made a slight little loss of 21 cents per share. Okay, so it's very important you always keep your losses to a minimum. Okay, this is a redefine. Also a short trade we had on recently. We put it on the 30th of September. We also closed this trade out today. We anticipated this movement out and didn't go like we predicted. It went down slowly and it went sideways for a bit, and then ultimately you can see your two moving averages acted like a very strong support level, and eventually we got stopped out today. We revised our stop down yesterday to 10.25, and we also again took a loss of 44 cents per share, but this actually turned out to be 4.49%, which is potentially a 25% loss. Okay, so you lose on some trades and you make them on other trades. That's the name of the game. Okay. So guys, just quickly, as I say, this presentation will be sent to you guys tomorrow. Please review it. Any questions you guys might have, please review it. You get the recording also. So just a nice way of reinforcing any ideas that you might have come up. And as I say, please send me the email. And the ideal situation, rather ask me the questions on our Facebook page so everybody can see from it. Okay, so they are geared, and that's what makes it attractive. They leverage, so they are capital efficient, and obviously they're more affordable. So those are the main benefits of derivatives. As I say, open up a CFD account and a single stock futures account. You must do it at the same time. You have to open up single stock futures and open up CFD accounts separately. We allow up to R1 million exposure. So you put it on 100,000 Rand, we'll give you up to R1 million exposure without asking for that's combined between single stock futures and CFDs, without asking for a balance sheet. More than R1 million, obviously we want more collateral, be it a share portfolio or additional funds. Those of you that are new to trading derivatives, I suggest always do your homework. You've got a bit of an insight tonight. What are these things? That's what I call product knowledge. That gives you the theory. There's a lot of information available on our website anyway regarding CFDs and single stock futures. Go read up more about it. But I suggest is just to do some paper trading. Before trading with real money, paper trade. When I say paper trade, either just open up an Excel spreadsheet and then track some trades from there. We do have a single stock futures simulator. However, it is just for ALSI and ALMI trading at this point in time. Okay, we are looking at upgrading that next year. But start small. You saw just now with Old Mutual. Just open up one contract. One contract, your margin is 390 Rand. You just start small just to gain the confidence. Okay, just understand how leverage works, understand how the costs work, understand that you can go long and short, and how the margin would move in and out your account. Okay. But most important thing that I want you to get from this presentation tonight, risk and management and money management are the most important things when it comes to trading derivatives. So it's important to control those emotions. It's a roller coaster ride. You know, it's great when you're making money. It's not so much when you're losing money. So you need to control your emotions. Your goal is to be objective. So when it comes to technical analysis and trading, I always believe in having a trading plan. And that is that you plan the trade and trade the plan. Okay. So let's see if there's any questions coming through. It doesn't look like it. I don't see any other questions. But from my side, guys, I hope you've enjoyed the presentation. I hope you've learned something tonight. So lastly, from my side, good luck and happy trading. Here's my email address, and there's my direct phone number. You guys are welcome to I prefer email. It gives me more opportunity to do investigation and research your question. But you guys are welcome to phone me also any questions you have around single stock futures and CFDs. As I say, if you do have existing single stock futures account and a CFD account, please, if you're not getting my stockbroker report, send me an email and I'll gladly add you onto the list. Remember, it's for existing single stock futures and CFD clients, fully funded account. It's not for the equity trader because of the gearing and the short percentage movements. It won't be advisable to use it for equities. Okay. So guys, thank you very much for your support. Thanks for participating in this webinar. Hope you've enjoyed it. And from my side, good luck and happy trading. And until next time, bye-bye.